Okay, again, thank you all very much for joining us today for our webinar on the IntelliCredit Portal. Why now is a good time to focus on your portfolio credit risk. My name is Sean O'Brien. I'm the president of QuickRate. I'm very pleased today to be introducing David Ruffin and his IntelliCredit team again to you. Some of you may have tuned into a webinar back in November when we talked a little bit about IntelliCredit, but today we're going to take it another step further and show you some of the tools that David and his team have built. IntelliCredit is the latest in a continuing stream of solutions that QuickRate is bringing to you. We started in 2013 with Quick Analytics. We added Quick Bonds in 2017, and then obviously in 2019 we're very proud to introduce IntelliCredit. We think it's very timely. We've been in what has been a very relatively benign credit environment for a number of years. Sadly, as all of you know, this may be changing very quickly. And so we think the tools that David, Larry, and David Littleton have built for you will help you have better insight into your own loan portfolios. And so with that, I'm going to turn the presentation over to David Ruffin. David?
Thank you very much, Sean. We look forward to continuing the dialogue with the extended QuickRate family, and of course, needless to say, extremely happy to be a part of that family. Just briefly today, we'll be looking at the IntelliCredit Portal, what that is. We'll talk a little bit about some of the issues of why this is, of course, important of looking at and assessing credit risk in the portfolio. We'll give you a demonstration of the tool. We'll talk a little bit about some of the most recent guidance in terms of the coronavirus pandemic and how it's affecting financial institutions. And then we'll close briefly with how you can participate or subscribe. IntelliCredit Portal is what we call a combination of the Portfolio Analyzer and Smart Loan Review. It is a multifaceted array of tools that give you the ability to look at aggregate or macro performance in your entire credit portfolio, but also tie that to transactional, which means you're able to drill down to the given loans that may comprise either good or bad trends or anomalous behavior. So, and most importantly, we think it has been built and nurtured by credit specialists, people that have been in the trenches, like many of you on the call perhaps today, that have been there doing credit work and understand the use and need for technology in today's world to assess credit risk. The other thing that it certainly does is provide you a whole array of robust reporting and charts. But I think rather revolutionary, we have made it an attempt to also put loan review tied to the portfolio analytic tool, which is, I think, a bit revolutionary in the industry. You could argue that loan review as a model probably hasn't changed in 40 years. So we really made an attempt to try to bring loan review out of kind of its isolation as a one-off event or engagement, and begin to tie that into how portfolios are analyzed. And I think most importantly for the user and subscriber, of course, it allows you to script your own credit risk profile before someone else or even regulators do it for you. Why is this important in today's environment? I think I was actually submitted an article last week to some trade associations, and it's very, very pertinent, I think, some issues that came up because of the nature of where we are today, and it relates distinctly to the IntelliCredit Portal and what I think we can provide for you. One of the things that I talked about in that is the fact that irrespective of our need to be focused on cash flow analysis, I think you cannot deny the importance of underlying commodity values of whatever industry you're lending into. For instance, it was the collapse of housing values in one-to-four family housing that led us into the Great Recession. And you can just begin to pick any other industry to determine what are the economic or forces at play there that are either causing more credit stress or more revenue degradation to that particular industry, which gives you the ability to understand where are you in that perspective in your portfolio, which of course brings us to the black swan. And of course, black swan is an unexpected but very impactful negative event. And unfortunately, we now have our own black swan, which is the coronavirus pandemic that we're dealing with. One of the things that we have to accept, because is that, you know, as the crisis grows and the economic shutdowns expand, there'll probably be few industries that really are left unfazed. But there's also a sense that this is so existential, so widespread, and kind of beyond our control. And I think one of the mistakes we'll make in the financial industry is to just say, well, it's nothing we can do about it because it is beyond our control. We think, on the other hand, any crisis that you're dealing with, you just need to be the captain of your own ship. And what that means from our perspective is understand your position, quantify it, and describe it, again, before regulators do it for you. We think, for example, that the IntelliCredit Portal will help you do exactly that, and we'll show you that in just a couple of minutes. But how do we determine your credit risk profile? I think we would recommend deep analytic and diagnostic dives into a few key metrics. One would be certainly concentrations. We're not just talking about real estate. We're talking about any type of business or loan type concentrations, and we are big advocates of peeling the onion down to more subsets of loans in three primary categories: quality, profitability, and growth. But also don't neglect correlations, which is kind of first cousin to concentrations. Think about it this way: it wasn't just the direct loans to housing or tract developers that created a lot of failed banks a decade or more ago. It was a lot of the correlated or related business portfolios to all things housing that brought down a lot of stress on the financial industry. Industries, even more precise. Some of you may be tracking your industries and with NAICS codes. Again, we have that capability in the IntelliCredit Portal that we'll show you in just a moment. We feel very strongly that that would need to be done. One other lesson that was partially learned, unfortunately, in the last crisis was that loans made late in a credit cycle, and it's been a very long and very benign credit cycle of late, tend to be the most toxic. And therefore, it's, you know, we think it's very, very important to be able to isolate your loan portfolio based on vintages and create risk profiles accordingly. Most of you on this call probably are credit specialists of one type or the other, and you do understand, I think, what I mean by this, that risk grade migrations within PASS is really the art of understanding emerging credit risk. One of the concerns we have about, you know, obviously waiting to criticize classified thresholds are met is almost too late. And we operate in what I call a structural bias around call report standards, which kind of give us this illogical phenomenon that all loans are good loans until they're bad loans. And I think that particularly in the environment we're in now, we would need to be looking at emerging risk profiles coming out of the past credits, not so much the ones that we've already acknowledged as criticized classifieds. And finally, we alluded to the fact we've attached loan review to the portfolio analytics, but certainly now is not the time to in any way, for efficiency reasons or the fact that you've had significant validation of numerous examinations by regulators of not downgrading anything, but now is not the time to in any way cut back on loan review. And servicing is another key point of that, because I think universally the financial industry is doing a really good job on initial underwriting, but what seems to be a clear pattern, even with regulators acknowledging this, that post-booking servicing is not up to par in some cases. So what does that mean in terms of where we go from here? Again, it means adopting and documenting your game plan, writing your own, using diagnostic tools to quantify your position, but also, in the end, writing your own narrative. One thing that's critically important is, again, please don't take the position that, well, this crisis that we're in today is of such magnitude, it's beyond our control, because one of the lessons, again, finally, that we learned from the last crisis is that and certainly backed up by empirical data, was that institutions late to the game in identifying their weaknesses always incurred greater losses. So these are some of the things that we think characterize the current credit landscape, but we also wanted to show you specifically what we think some of the solutions are. So at this point, I would like to hand the presentation over to Larry Poole, who will give us an indication of what the IntelliCredit portal looks like. Larry?
Hey, thanks so much. Thanks so much, David. First off, thanks for joining today. Before we dive into the demo even, I wanted to show you, now this is a chart and a graph that comes out of the demo, but I really wanted to spend a couple minutes even before going into the demo just talking about what I think is critical, the most critical part that Portfolio Analyzer solves for you as the bank, and that is the ability, as David has already said, to identify emerging risks within pass-rated credit. This graph below, our software is built on the basis of importing your bank's core system file. You'll hear me refer to that as part of the call as a flat file, but there's a lot of information that can be gleaned from the flat file. Most of your core systems, however, are designed as data repositories, whereas we have built kind of an analytic engines. We say often around here, we don't want you to be in the data aggregation business. We want you to be in the data analysis business. So what you see here is this is a bank that has uploaded 5 historical flat files within the portfolio, and we're comparing the year-end 2018 flat file to the year-end 2019 flat file. The 2018 flat file is represented with this light blue line, and the 2019 with the dark blue line. This is a bell curve that shows the risk grade distribution for, this is the same bank over a 1-year interval. And what you can see is that the risk is shifting from this bank where a large quantity of loans are moving from risk grade 3 to a risk grade 4. Now, most of the times at your bank, this wouldn't be an identified area of risk because those loans are still rated as pass credits. But this is obviously a degradation in credit quality. And if you have that knowledge as a bank, you can really get out in front of it and identify where is the risk and what are we going to do as a bank to mitigate any further credit degradation. And it's not just at the portfolio level. Let's say that you were interested in looking at your C&I portfolio, that you thought there was maybe even some more hair and risk on those loans. If I wanted to look with Portfolio Analyzer at my C&I portfolio, you can see here that there's even a greater degradation in credit risk for the C&I credit. So I think this really is the whole crux of the Portfolio Analyzer, is being able to identify risk pockets and subsets of loan sets within your portfolio so that you can be proactive in mitigating loss and mitigating risk. To give you an idea of the IntelliCredit portal, this is a web-based application. You can access it securely from any computer. We built it with strong security controls around your bank, since personally identifiable information will be uploaded within the cloud. Every bank will be given a login, a unique user ID and password. Once you sign in into the IntelliCredit portal, you're going to land on this landing page. And before we get into some of the functionality, let me briefly walk you through how this is organized. At the top, you will see your bank name. You will have the option to select the flat file or the core system file or series of files that you want to analyze. Again, this is a bank who has 5 quarterly flat files that have been uploaded. At the top of the page is just some key analytics on your specific portfolio. The middle of the page allows you to analyze asset quality trends, compare 2 flat files, either by risk grade or days past due. And then at the bottom, we've got some the ability to view your portfolio in different ways over the time series as represented within the flat file. So here is a distribution of the portfolio over 5 quarters based on risk grade groupings, and we'll get into that in a little bit more. To the left side, we've provided some standard reports that we think would be critical to you as a credit officer of a bank or credit union. We also have the ability, you have the ability to generate some custom reports. As David said, if we do the external loan review for you, our portfolio analyzer tool ties in with loan review, or if you're using this application, if you license this application to do internal loan review on your bank, then it would also tie in with the portfolio analyzer tool. And then we'll kind of talk about our investment in video conferencing as part of this application, because we're not just selling you a data model or a high-tech dashboard. As David has already said, we are credit people at heart, and not only that, we're credit people at heart who are backing this with customer service. We're not just going to hand this off to you and never hear from us again. We want to be engaged with your bank and credit union to ensure that that our product is maximizing its return for you. Kind of how this is designed on the home page, every table or every chart that you see, you as the loan officer or credit officer within your bank, you have the ability to go from the aggregate to drill down, as David said. So one of the things that I would do if I'm the chief credit officer of a bank or a credit union, I don't want to have to wait 2 weeks to see what loans have moved to non-accrual, or what loans have moved from pass to non-pass, or what loans are now 30 days past due. So what I would do as a chief credit officer, after each month in, I'm going to upload my flat file. Based on the upload of the flat file, I've got some high-level data here on the portfolio. Probably one of the first things that I'm going to do, I see that my portfolio is $319 million. Of that $319 million, we've got $9 million in loans that are 30 days past due. I want to know what those are. So if you just click on any cell within this, you can drill down. So you can see we've got 19 loans within the 9/30/2019 data set that are 30 days past due. I want to see all 19 of those loans. The way that this drill down is organized, each drill down chart shows you the data set date. That's obviously the date of the flat file, borrower and loan officer name, note number, balance and exposure. You can see interest rates and FFIC product codes, risk grades, and the days past due. You can see a loan's origination and maturity, whether it's on non-accrual, and then delinquency counters for that specific loan. So again, remember, this is loans that are past due 30 days. We've got 19 of them. Each of these columns you can then sort. What I probably would do as a chief credit officer is sort and say, why do I have loans that are risk grade 3 and 4, which are past risk grades for this institution, that are greater than 30 days past due? Again, very quickly you can get to risk within your portfolio. Perhaps you wanted to say, okay, I want to see all my criticized loans as of the data set date. Again, you could drill down and you could see the criticized loans within the portfolio. The portfolio analyzer also quickly allows you to see various distributions within your portfolio. So what is shown here is a pie graph based on the distribution by FFIC product code. You can see that the largest segment of this financial institution's portfolio is 1C2A, or first lien residential mortgages, $100 million in balances, which represent 32% of the portfolio. And as I said, each chart, graph, or cell, you can then, by clicking on it, you can drill down and see what loans make up that subset within the portfolio. We've also have a section here for charge-offs and recoveries. You can upload your bank's historical charge-off data within the portfolio analyzer. We've got this displayed right now, the time series of historical charge-offs by quarter. Perhaps you just wanted to see your total charge-offs or your total recoveries. You have the ability to do that. You could also view this if you didn't want to view it quarterly, but you could view it monthly, or even aggregate the data by fiscal year end. Moving down, asset quality trends, again, gives you the ability to compare flat files to each other. So if I wanted to compare the bank's 9/30/2018 flat file, I've just selected that, to its 9/30/2019 flat file, I can see a couple things. One, this bank portfolio over the last year has grown from $241 million to $319 million. But but I also see a growth in my criticized and classified loans. So if I just wanted to see how that, let's say classified, so all your substandard and doubtful loans have increased year over year. If you drill down, I now have displayed last year's data set of classified loans, which was 5 loans, versus this quarter's data set of classified loans, which is 6 loans. Again, just gives you the ability to track risk and how it's moving within your portfolio. You could also organize this section by days past due, so you can see a distribution of your loans by days past due and how those balances are changing. At the bottom, again, we've given you the ability to look at composition of your portfolio across various data set dates. So in this instance, let's say that this shows your data set, each grouping, each flat file grouping by risk grade. Let's say you just wanted to view your criticized and classified loans. The charts give you the ability to deselect areas that you don't want, and now I've got a chart that shows my criticized and classified loans graphically over the last 5 quarters. Each of these tables, charts, and graphs can be easily downloaded as picture files or PDFs so that you can then take and include them within other bank reports as you see fit. So here's an example. We've just downloaded a image file that could be included in a report at the bank. Moving on to kind of some of the standard reports. I don't want to go through each of these. What I'm going to show you maybe represents 10 to 15% of what is in the analyzer as of today, and we're continuing to improve on that. But I wanted to talk about some of the key areas that David discussed. One of the things that he said, we've already covered risk grade migration, but another thing that he said was important was loan vintages, that loans made in the latest stages of a benign credit cycle tend to be the most toxic. Here is the bank's distribution of loans by loan vintage, so that's simply the year of origination. If I look at the chart below, what I see is that a large majority of loans, 40% of loans on the books for this bank were originated within the last year. Roughly 60% of loans were originated in 2018 and 2019. And if I scroll over here to the right, what's concerning to me, if I'm in the credit function of the bank or the credit union, is many of these loans that have been originated in the last 2 years are already showing delinquencies, 30-day delinquencies, and some are even criticized and classified. So again, if I want to see loans that were originated in 2019 that are now 30 days past due, any sale, you can drill down. Here's the 4 loans that originated. You can see in this column right here that were originated in 2019 that are already 30 days past due. Something else that David mentioned was the ability to identify concentrations. We have a report called Top Borrowers and Concentrations. This chart right here shows the top borrowers within my bank. It is showing the top 10 borrowers within my bank. This is a dynamic chart and table. Maybe you wanted to see the top 20 borrowers within your bank. The top 20 borrowers within this bank, if you look at this cell right here, represent about 30% of my overall portfolio. Perhaps you wanted to see this by relationship groupings, maybe your top 10 relationships. Here are the top 10 relationships within my bank, and again, this is dynamic. You can enter the count and see the number that you'd like. But again, my top 10 relationships account for roughly 25% of loan balances. Each of these relationships, for instance, this relationship to Punit consists of 8 loans, $9 million in balances, and again, you have the ability to drill down and see exactly what those are. Perhaps your bank tracks NAICS codes or industry codes. We also have the ability to show the top industries within your bank. So here's the top 10 industries. Let's look at the top 20. One of the things that I would do if I'm a credit officer, given this coronavirus pandemic, as David has already alluded to, we know that this is disproportionately affected service industries. So what I've done now is organize my bank by industries, and just looking over these, I see we do have 18 loans to restaurants. I would want to know what are those 18 loans, Have we reached out to the borrowers? Do we know what their plan of attack is? I see also we've got some loans to hotels, 16 loans to hotels. As a chief credit officer, I would want to know what those 16 loans were so we could be effectively monitoring those at the bank. One other thing which I think is interesting within our portfolio analyzer is the ability, we've got a chart called pricing for risk. And what this shows is our bank or our credit union adequately pricing risk as informed by risk grade. All of these red highlights that you see are automated, and they represent anomalous data. So to give you some context, along the vertical axis, we've got FFIEC product codes. Along the horizontal at the top here, you can see risk grade. In theory, as loan risk grades get worse, you should see an increase in pricing. But that's not the case for some of these product types. So for instance, farmland loans, you can see farmland loans that are risk graded 2 carry a weighted average interest rate of 550 basis points. That actually decreases for risk grade 3 and further decreases for risk grade 4. Another view, perhaps you wanted to see how are your loan officers doing pricing their loans. One of the things when I organized this by loan officer, I noticed Samantha Powell is kind of a bad offender. Her risk grade 3, risk grade 4, and risk grade 5 loans, the pricing of those loans do not really reflect the embedded risk within her portfolio. One of the things that I do each time IntelliCredit does a loan review and we pick a sample, usually we pick a sample called a risk-based sample. And to do that, I'm using this loan quality indicators chart. So the first thing that I do, I want to organize my portfolio by risk grade, and then I'll look over here to the right and say, out of these past risk grades, do I see any loans that show 15 to 29 days past due, 30 days past due, or have any payment issues? So for instance, if I'm looking at risk grade 4, which is looking at risk grade 4, which is a pass loan for the bank, and scroll to the right, I see that a significant number of these have payment issues. So if I drill down, you can see out of these risk grade 4 loans, and there's 12 of them, all 12 of these loans, if I look at delinquency counters at the far right, show significant 30 days, 60 days, or 90 days past due. These 12 loans, if I was picking a loan sample for a loan review, would absolutely be included in the risk-based sample, because although they're graded as pass now, historically they have performed in a manner which would suggest that these may not be pass-rated credits. One other thing I wanted to spend a moment on is loan review. How David said we have essentially tied loan review to this portfolio analytics tool. If you license this for internal loan review, or if you engage IntelliCredit to perform an external loan review, you will easily be able to track historical loan reviews and the number of loans that have been reviewed over the last 18 months. So for this financial institution, it shows 3 loan reviews that have been performed over the last 3 years. If I wanted to go to the reporting portal to see information from my most recent loan review, you could just click on this reporting portal tab. What this demonstrates for you is a loan review in process. Let's say it's an external loan review. We've picked a 50 loan sample. Thus far, we've completed 6 of the loans within the sample, and 45 loans remain to be completed. One of the biggest things that we're hearing, one of the biggest positives for our banks that are already on the portfolio analyzer tool and using it for loan review as well, is just the efficiency. Specifically with report delivery, you aren't having to wait for us to review loans, write up those loans, give them to you as a report at the end of the week. You have access to the portal, and in real time you can see everything that we are doing as a loan review firm. And the same would hold true as if you were doing this internally. If you would click on individual loan review reports, you could easily see high-level information of the loans that have been completed. Perhaps you as the Chief Credit Officer wanted to see the individual loan write-up for the Ackerman Solar loan that has been reviewed. You could easily click the hyperlink, and here is that individual report. We've also made it easy for you to identify loans that have recommended risk grade changes. So here are the 3 loans as part of the internal or external loan review have recommended changes. Again, you can essentially drill down into these and see each of the individual loan write-ups. And then finally, we have a management and board report section. When we do the external loan review, we provide each bank or credit union with a board level report. Think of this as a 10-slide PowerPoint deck with our really distilled key findings, and then we also provide you with a more robust management report. This one's 30 pages long with all of our key findings and even more supplemental charts and graphs. Perhaps the thing that I think is most revolutionary in our loan review is the way that we track exceptions. Now, I think this is something that you could use as a bank, even if you're happy with your loan review vendor or you've got a great internal process. One of the things we're consistently hearing is we have trouble with tracking exceptions within our portfolio. We have divided exceptions into 3 categories: legal doc exceptions. Those would be errors within promissory notes, deeds of trust, title policies. Credit exceptions, those would be things such as missing financials, annual reviews, covenant compliance certificates, and then loan policy exceptions. Perhaps your institution has made a loan that is below traditional debt service coverage guidelines or has a high LTV. It would give you the ability to track and identify those. And I just want to take a moment to show you how this would work and how this would be even cleared real time as part of a loan review. Let's say we go to legal doc exceptions. This chart identifies all the legal doc exceptions that have been identified as part of the loan review. What would happen here as a bank user, for instance, for Ackerman Solar, you can see that we have said a guarantee agreement is missing. You as the bank would go in here, click on the upload file. You could easily drag and drop the file that you wanted to upload. Once you upload that file, it would appear right here. You can see the file has been uploaded, and this would tell us as the loan review vendor, we have, here is the guarantee agreement that was missing in the file. It is ready for you to review, and then on site, IntelliCredit could easily clear that exception. We also have the ability, you have the ability to track missing financial documentation. One of the things that I think is neat about this, we've also created a very simple way to disseminate information. So as I'm looking at these credit exceptions that have been identified as part of the loan review, I see that there's many credit exceptions for missing financials for loan officer Ted Jones. If I wanted to pull down all of Ted Jones' exceptions, I would just search for him, select his exceptions, and then I could easily print out a report with each of Ted Jones' exceptions that appears down here on the left. Once I open it up, excuse me, once I open up the report, now I have an exception report specific to Ted Jones, which I could easily email to him if I'm, let's say, loan ops in the bank and say, hey, can you please give me an update on these missing financials? Last thing I really wanted to show you as part of the loan review analyzer, as I've already said, we've built what we think is a very robust data analytics tool, but this comes with the full support and backing of us as a partner, not just selling you an off-the-shelf model and you won't hear anything from us. We want to be and provide you with excellent customer service. One of the things that we've invested in heavily even before the coronavirus is just the ability to chat with you face-to-face as issues come up. So one of the things that I wanted to show you today, we often communicate via what we call whereby. So here's our whereby channel. Just wanted to say, hey, on the far right is our principal, David Ruffin. In the middle, our manager, David Littleton, and then myself. But as you have issues, if you subscribe to this tool and something doesn't make sense or you have a question, we're just an email and a video chat away, and we will support you. We want to be excellent partners with you throughout this process. So just wanted to say hey to you in person. So the biggest takeaway that I think you can get from all of this, before I turn it back over to David is what he says, being able to be the captain of your own ship and show the regulators that you have a very solid handle on your portfolio with the ultimate effort of minimizing risk, losses, and increasing profitability for your financial institution. So I'm going to turn it back over to David now, and he's going to close out by walking us through some of the regulatory guidance that has come out as a result of coronavirus.
Great. Hopefully you can see my screen. And I think one of the things that relative to the video conferencing, that's not only used for communication with IntelliCredit, it certainly would be able to be used in a financial institution. And frankly, given the circumstance we're in now, I guess you could consider that the ultimate social distancing, right? But it is certainly something that we see being used appropriately. One of the things I didn't say at the beginning that I think is critically important is that unlike 10 or 12 years ago, there's no one in their right mind that could say this crisis could be put at the feet of the financial institutions. So therefore, nobody should anticipate, punitive measures coming either statutorily or regulatorily against the financial industry. But one of the, and even in that regard, we in the last couple of days, of course, had interagency statements across all the banking and credit union regulators and state regulators, basically saying that the industry has every right to consider COVID-19 related credit, to take positive proactive measures to mitigate adverse effects. That would include things such as modifications and also the treatment. Inevitably, what people were fearful of 3 or 4 days ago, of course, is the great explosion of TDRs perhaps, or even implicit in that added reserves. But the regulators have come out and clearly stated the need to do, that we're in a crisis and here's what we need to do. Specifically, loan modifications do not automatically result in TDRs. There's suggestions that short-term modifications up to 6 months could be made in good faith without any triggering of a TDR or trouble debt restructuring classification. Presumptions are that if the loan is current at the time of the crisis, then that would certainly justify that, and that it is no need to pursue the TDR. Past due reporting also, financial institutions are not expected to designate loans with payment deferrals granted due to the COVID-19 crisis as past due because of the deferral. Likewise, those that were affected by this would not be expected to identify these as non-accrual loans. It does state, probably reasonably, that if for whatever reason information comes to the financial institution that a specific loan just cannot be repaid going forward, then probably applicable charge-off guidance should be followed. We've identified the link here too. This also brings up what we talked about on our webinar in November, and that was the interagency have come up with proposed strengthening or buttressing of credit risk review systems, largely in an attempt to make sure that we see, things that we've talked about on this webinar already, emerging credit risk. It was out for comment in December. It hasn't been finalized at this point. But again, we just want to assure you that every aspect of the IntelliCredit portal, the portfolio analyzer, and the loan review module, smart loan review, would certainly address all of these proposed issues within their interagency guidance. And I think we've come to the end of the webinar here, and we just want to thank you very much for attending. Again, we're just very, very pleased to be part of the Quick Rate family. We would love to hear from you. There is a survey that will be sent to each of you on the, and please consider filling it out. It's not just, it's basically issues of what are you doing relative to some of the assessments that we've been talking about, and if you would be so kind to share that with us, that would be great. Again, please, thank you very much for attending today. I know your time is valuable, and we look forward to hearing from you. Again, thank you so much for your attention today.